Hello, everyone. Welcome back to another edition of the Weekend Charts. I'm your host, Charlie Bilello, bringing you the most important charts and themes that I'm seeing today. Huge show for you this week. A lot to talk about. Obviously, we have the election, we have the Fed meeting, so much more. So stick around to the end. And if you're watching this on YouTube, just take a quick moment, hit that subscribe button. We have a lot of good content coming out in the next few weeks. I don't want you to miss it. So hit that subscribe button and make sure you're subscribed to the channel. You get all the latest updates. Before we begin, just another reminder, go to creativeplanning.com/Charlie. Get a second look on your portfolio or your financial plan. You can get this free wealth path analysis from us at Creative Planning when you schedule a call or a meeting with us today. So go to creativeplanning.com/Charlie. At Creative Planning, we're in all 50 states, so likely have a location right near you, over $325 billion in assets under management and advisement, and we're here to help. So go to creativeplanning.com/Charlie. What's on the docket today? Number one, a rally for the ages. We're going to talk about all of the moves in financial markets after the election. Number two, easing into a melt up. That would be the Federal Reserve. We'll discuss what they did in the latest meeting and what the expectation is going forward. Number three, within the Dow, Intel is out, Nvidia is in, and this is after a historic move in Nvidia, so we'll discuss that. And obviously, Intel doing very poorly in recent years. Number four, I'll give you an earnings update on the S&P 500. Earnings continuing to come in pretty strong, hitting record highs once again in the third quarter. Number five, Buffett seems to be getting more bearish. If you just look at what they're doing in terms of their stock holdings, net sellers once again in the third quarter. So we'll discuss that. And we'll end, as we always do, with something positive. That would be falling gas prices. Gas prices in the U.S. hitting their lowest levels since January. Okay, let's start out with the rally for the ages. Really unbelievable moves, mostly in U.S. equities, but other things as well. We'll talk about all of that here. First, on the election, Trump wins. He wins pretty much projected to win now all 7 swing states. And the Senate, Republicans take control of, and the House seems to be headed towards the Republicans as well. So that would be a clean sweep, meaning that they likely will be able to pass some legislation in the next few years, and also likely that the tax cuts that were implemented that were set to expire are likely to continue as well. Was this predicted in terms of the polls? Not really, but as we've learned, the polls haven't done a good job the last few elections. You can see here, looking at the polls, what they were projected in terms of these swing states and what actually happened in terms of the results. You can see Trump doing much better than were predicted in pretty much all of the major polls. And who did get it right? It seems like the betting markets, once again, getting it much closer to accurate here. They had Trump ahead heading into election day. I think about 54, 55% chance. So it wasn't huge, but certainly they had him in the lead, and that obviously actually was accurate. Now, did the betting markets get everything right? Definitely not. They were not projecting the Republicans to win the popular vote here. And that is actually what happened here. So big surprise there. I think it was about 75% odds that Harris would win the popular vote heading into the election. And so not predictive whatsoever on everything. But it seems like if you're going to pick one, polls or betting markets where people are putting actual money on the line, the betting markets overall seem to do much better. Okay, let's talk about the market's reactions here. Volatility index, VIX, it was just setting up for yet another post-election rally, regardless of who won. You could see the VIX here was above 20, so elevated volatility. And what happens is when you remove that uncertainty, what you do is you get a springboard higher for the market. You can see here on election day, the VIX immediately coming down here, and it continues to move lower. I'm recording this around 3 p.m. Eastern on Friday here. So you can see volatility coming down, and what the algorithms do is they put more money to work. When volatility comes down, they're taking off their hedges. That uncertainty is removed. A lot of people were saying maybe this election result was going to take days or weeks for us to find out. It didn't end up happening. It happened much quicker than people thought. So you had that uncertainty removed, and what you saw was the stock market just surge higher. Futures were higher heading into the open and after the election, and they continued to move higher thereafter. We now have 49 all-time highs for the S&P 500 this year, and I'm recording this again on Friday, likely to be the 50th all-time closing high this year, one of the strongest years in history for the stock market in the US. And you can see here, updating this chart, where the S&P is today versus the average target, now 23% above the average price target among Wall Street strategists. So no one predicted this move. We're now over 500 points above the highest target heading into the year. So extremely, extremely strong year. You can see that more clearly on this chart right here. It's now the 12th best start to a year in history. You got to go back to 1997 to find a better start to a year than 2024, with the S&P 500 up over 25% here. If we look at the milestones here for the S&P 500, it's really been very steady throughout the year, and that's been because we did have two pullbacks during the year, but they were very brief, and the markets very quickly recovered to hit new highs after that. So we had that August pullback, if you remember, when the VIX spiked back then, and very quickly the market recovered to hit new highs. And we're looking at here now running up, hitting that first milestone here, 4,900 after the bear market back in January, and now we crossed above 6,000 this week for the S&P 500. Just so incredible move higher for U.S. equity markets. If we're looking at the Dow here, hitting 44,000 for the first time. You can see here it was at 38,000 back in January, so just continuing to trend higher. NASDAQ Composite as well here, milestone 19,000 hitting this week. So all three major indices hitting record highs, hitting these new milestones. And if we look at what's happened so far since the election, you can see here, again, around 3 p.m. Eastern on Friday, Coinbase, so crypto, we'll talk about that in a little bit, getting a big boost. And the narrative is that Trump is going to be more favorable for crypto. And that provided a boost there for crypto and things related to that. Coinbase being obviously a major market for crypto trading, up 40%. Tesla, of course, Elon Musk, they're a major player in terms of his endorsement. And the expectation, I guess, is that he's going to benefit from that or in some way. Stock is up 29%. Bitcoin, 11% gain since the election. Bank stocks, huge moves across all of the major bank stocks. The narrative seems to be that there's going to be less regulation around the banks and more M&A activity. That will be good for banks, but huge move, 9% gain. And JP Morgan, Morgan Stanley, Goldman Sachs, just huge moves, all of them since the election. Small cap stocks, and this is kind of a deja vu moment because we've seen this the last few elections, just small caps rocket higher after each of these elections happened back in 2020, happened in 2016. You're seeing a 6% gain since the election. Huge week for small cap stocks, huge outperformance. And S&P 500 not bad as well, up almost 4% since the election. Dollar index, this is pretty interesting, strengthened the dollar since the election. So interesting to see that. And you have on the other side yields moving higher, though not very much. Initially, they were much higher, but then they came back in. So you see long-term treasury bonds actually down a little bit. And this is really interesting given the strength in the U.S. equity market. We actually have international developed stocks down 1%, emerging markets down a few percent. You could see China here down 4%, and crude oil down 2%. Gold is actually down 2%. That's an interesting one, maybe because of the strength in the dollar there. Trump media actually down. Initially, it was up, and then it reversed. And the VIX, the volatility index, down 26%. So just a word on all of these election moves. This doesn't mean, this is all short term, doesn't mean a year from now all of these things are going to play out this way. If you look back to 2016, a lot of the initial moves in terms of outperformance and underperformance reversed itself within the subsequent, let's say, few month period. But interesting that it's really kind of been a deja vu in terms of some of these things rocketing higher. And it's really been the third straight election that we've seen stocks just roar higher after election day. So this is that small cap index. We were talking about this earlier in the year because we had the S&P 500 hitting an all-time high back in January, and we had the small cap stocks down over 20% if we're looking at the Russell 2000 back then. And what I was saying at the time, looking back in history, the last three times that had happened, you had a huge gap between small caps and large caps when the S&P was at all-time highs. What happened was actually bullish for the markets overall and bullish for small cap stocks, and now we're seeing that again. So each of those prior examples, we had small cap stocks catch up and rally to new highs, and finally this week we saw that happen again. So whenever you hear that narrative that there's weak breadth, that average stock isn't participating, people often say that's a bearish thing for market, but there's really no historical precedent for that whatsoever. What tends to happen is small cap stocks tend to catch up to large caps, and that's actually what's happening now once again. First all-time high for small caps for the Russell 2000 since November 2021, which is kind of remarkable because we had all of those all-time highs in the S&P 500 this year, and now we're just seeing small cap stocks hit new highs as well. Okay, let's talk about Tesla here. This is the chart. It's unbelievable, kind of stunning, the move that we've seen in Tesla over the past few days. Again, we'll see if this persists, this continues. Obviously, you're going to need to see fundamentals at some point back this up, but for now, the narrative is this is going to be bullish for Tesla. There's some talk about maybe removing the EV credits is going to be, tax credits is going to be bullish for Tesla because they're in a better position than these other automakers, than their competitors to withstand that removal. So there's that narrative as well. So interesting to see that move, and Tesla back now at $1 trillion market cap, joining these other big players, and interesting to see Nvidia once again at the top of the list in terms of market cap, actually surpassing Apple this week to claim that #1 spot. So let's talk about crypto here. Bitcoin surging higher as soon as it became clear on election night that Trump was likely to win. You saw Bitcoin surging higher back to record highs. We hadn't seen a record in Bitcoin since March. It was kind of trading sideways to down since then, but surging higher with the election here, 74,000, 75,000, 76,000, and then 77,000 this week. And so far, it's up 82% on the year. If we look at credit markets, this is unbelievable in terms of the strength in credit markets. Credit spreads now, if we look at investment grade bonds at their tightest levels since 2005, March 2005, almost, you're not that far off from record lows there. High yield credit spreads tightest since June 2007, 2.74%. So what's going on here is basically investors are saying we're so confident in terms of the economy, in terms of corporations and their strength, their health, that we're going to reach for yield and drive this spread between corporate yields and treasury yields down to these very tight levels. So we talked about this the past few weeks, but just continues here, tightening, tightening, tightening. Very rare to see, as we'll talk about in a little bit, the Federal Reserve cutting interest rates when you have these financial conditions seemingly so good, where you have credit spreads not showing any sign of weakness here. So investors are behaving, as I said before, as if there's never going to be a default cycle again. I won't say again what this tends to mean. I won't go into the charts, but what this tends to mean historically is investors are overly optimistic about the future when credit spreads are this tight. So they tend to be overly pessimistic when credit spreads blow out, like they were in 2008 or 2020. And when they're very, very tight, they tend to be overly optimistic. And what you tend to see is lower future returns with tight credit spreads and higher future returns with wide credit spreads. So just keep that in mind as you're looking at your credit exposure with credit spreads at their tightest levels in a long, long time. Okay, number two here, we have to talk about the Fed meeting this week. No surprise whatsoever. The big surprise, though, is that they continue to ease into a melt-up, and this is what I posted on X. Stocks are at all-time highs, home prices all-time highs, Bitcoin all-time highs, national debt just continuing to surge higher. Core CPI inflation greater than 3% for 41 straight months. That's the longest run of high inflation since the early 1990s. And the Fed is going to cut rates again tomorrow. And I did my tomorrow's news today, which I always do before every Fed meeting. And I don't have a crystal ball. I just look at Fed fund futures and see what the market's going to do, because the Fed in every single meeting since 2009 has done exactly what the market was expecting it to do. And the market was pricing in a 25 basis point rate cut, almost 100% chance. And that's exactly what the Fed did. They cut 25 basis points down to 4.5 to 4.75%. Now, where does that leave the Fed funds rate versus inflation? 4.5% is the lower bound. You could see their preferred measure of inflation, core PCE, at 2.65%. So if you're just looking at the way the Fed looks at it, there's about a 2% gap between the two. So the Fed is saying policy is still restrictive here, and perhaps they're going to continue to cut, right? So if you're just looking at it on a formulaic basis, you would project the Fed's going to continue to cut unless we see some kind of problem with this core PCE or other inflation data. The Fed seems to want to cut at least one more time. The market is projecting that for December, as we'll talk about in a little bit. But in terms of the balance sheet, they continue to let their balance sheet roll off. It actually hit its lowest levels this week since August 2020 and is now down about $2 trillion from the peak. So pretty remarkable that we've cut off $2 trillion off the balance sheet, and we're talking about this huge rally in equity markets with the S&P 500 hitting all-time highs, which is, again, another reason to ignore the Fed when it comes to your portfolio. A lot of people are saying when the Fed's going to pull back the balance sheet, the stock market's going to suffer. And in 2022, it did go down, but since then, we've seen an even bigger pullback in terms of the balance sheet, and we've seen the S&P 500 up over 20% last year and over 20% again this year. So be careful with that saying, don't fight the Fed. That hasn't been true historically. And actually, the worst times for investors have been periods where the Fed's aggressively cutting interest rates because they're fearing a recession. Now, we're not obviously there today, but in terms of saying there's a simple formula when the Fed is easing or the Fed's doing QE, you want to buy stocks, and when the Fed is cutting interest rates, you always want to buy stocks, and the opposite is true when the Fed is hiking interest rates. Not that simple. Historically, there's almost no relationship between the two. Okay, let's talk about inflation expectations here, and this is going to be a problem for the Fed if it continues to move higher. We're seeing 5-year break-even inflation rates. So this is the market's expectation for future inflation surging higher here. You can see when they cut rates back in September, this was at 1.86%, so it was looking pretty good. And the Fed's probably saying, well, we're in good shape here. We can cut. We can be aggressively cutting. They cut 50 basis points. But now we're in a different place here, highest since April, 2.46%. If this continues to move higher into December, I think this is going to be a problem. During the press conference, Jerome Powell said, we will not allow inflation expectations to drift upward. So obviously, he means more than this, because clearly they wouldn't have cut interest rates. But to me, this is drifting upwards at a rapid pace. If this continues, going to be a signal for the Fed to say, slow down. Maybe we have to pause here. So interesting in the press conference. I thought this was a funny moment. There was a question put to Powell saying, some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go? And he simply said, no. There was no elaboration. And that just reminded me of this Wolf of Wall Street scene where DiCaprio does this whole speech and he essentially says, I'm not leaving, I'm staying. And so it seems like Powell's not going anywhere. I'm not so sure they're going to ask him to leave, but I thought it was a funny moment in a press conference that's usually doesn't have much levity at all. And what I would say in terms of the Fed, in terms of removing Powell, we'll see what happens with all of that. But what Congress should do is they should restrict the powers of the Fed. So even if you want to make the case that we need a Federal Reserve, we need a bank regulator, we need a lender of last resort, what we don't need is the Fed manipulating financial markets, manipulating the housing market like they did back in 2020, really freezing the housing market potentially for a whole generation of home buyers, what they did back in 2020. So first order of business, I would say, if you're going to talk about Fed powers, is remove this ability to put trillions of dollars of mortgages on their balance sheet. You can see back in 2020, the Fed buying all of these mortgage bonds and continuing to buy mortgage bonds with U.S. home prices surging higher, and they're buying them month after month. So they really have no credibility when it comes to talking about fighting inflation, because you could see inflation building month after month and they ignored it, continued to buy it, drive mortgage rates down, and now we have a whole generation of potential home buyers who are going to be priced out of the market because of that. And so start here, I would say, and then go from there in terms of reducing powers. We can debate what the Fed's powers should be, but I don't see any reason why the Fed should be allowed to just unilaterally print money and go out and buy these securities and distort financial markets. The mortgage rate should be determined based on supply and demand, not what the Fed thinks it should be. And obviously, when they're buying mortgage bonds, when the housing market is already on fire, already at record highs, that's a big problem. That's a huge credibility problem to say that they should be trusted to do that going forward. So hopefully they'll continue to let this roll off. If it was up to me, they should sell it off completely and say we're never going to touch the mortgage market again. Now, what's the expectation for the Fed for December? As it stands right now, 68% probability that the Fed does another 25 basis point cut down to 4.25 to 4.5%, and about a 32% chance that the Fed just holds in December. So a little bit more evenly split as we go now. As I said, I think the Fed wants to do one more, and then maybe they'll think about it. Just listening to Powell, listening to the language, that was their projection back in September. We're going to do 100 basis points in total cuts for this year. So I think they want to do that. They would prefer to do that. But if data really goes the wrong direction in the next 2 months in terms of inflation, or in terms of bond yields continue to push higher, inflation expectations pushing higher, I think that perhaps could lead to a pause. But as it stands right now, they would want to do at least one more cut. This is what the market's saying for the next few meetings here. Essentially, cut 25 basis points in December, then we get a pause in January, another cut in March, then we get a pause in May, and then another cut in June and a pause in July. And the Fed is pretty much done for the year, I guess the market's saying now, as of next June. So they're going to do all of the work in the first half of next year. So huge shift. Again, when the Fed cut interest rates back in September, only talking about 2 months ago here, the market was expecting this Fed funds rate at the end of 2025 to be 2.8%. And now it's moved all the way up to 3.74%. So huge upward move. And the market's essentially saying to the Fed, slow down. Maybe that war on inflation that you've been saying has been won. Maybe it hasn't been won just yet. And I think, again, if you're looking at long-term bond yields, that would be the thing that you want to point to. And looking at inflation expectations, the market's saying we're not just going to get back to 2% or below 2% and stay there. It's going to be a little bit trickier to get down there. And look at the next few CPI reports. This is the Cleveland Fed here putting out these estimates. They usually do a pretty good job looking at the next meeting. So we'll get that next CPI print next week. And what they're projecting is around 2.6%. So that 2% inflation that the Fed's been talking about, that they've gotten there, and that's why they can cut, still not there. And if we look at core inflation, we're looking at around 3.3%. So still above 3%. That, again, will continue that streak for core inflation. So the Fed can talk about 2%, but we're still above it. And so far, the projection for November is it's going to go up even more, CPI. So this might be some troubling data points for the Fed in terms of, will they really be able to cut interest rates aggressively heading into next year when we're still above that 2% target. So what about the yield curve here? This is looking at 10-year minus 3-month. We talked about recently the 10-year and 2-year spread moving back to positive territory, but this remains inverted. It's the longest period in history of inversion for this spread, and this is becoming closer to a positive spread. You can see now only a 22 basis point differential between the 10-year and the 3-month, and the 3-month still above it. But I think by the time we get to that December meeting, there's a decent chance this will flip to positive as well and join the rest of the yield curve in terms of having a positive slope again, which would be back to a normal state. So for 744 days and counting, we've had this weird situation where short-term yields were above long-term yields, and we're getting closer to a state of normalcy. And similar to the tens and twos, what you'll note historically is when this flips back to positive territory, historically, that has meant that you're getting close to a recession. So when that happens, we'll revisit the data there and show you historically what has happened in terms of that relationship. But if we look back at history, just a reminder here in terms of what a long leading indicator this is. This first inverted back in October 2022, and now we're over 2 years into it, still inverted. And the average lead time in terms of that first inversion and when the recession starts is about 24 months. So we're at 24 months and a little bit right now already. So that's kind of at the average, but you can see here, there's been times where it's taken longer, 31 months, 30 months, 50 months. So there's no set formula in terms of this yield curve and when the recession begins. So it's been a very good leading economic indicator. The problem historically is that there's a huge range in terms of its predictive power of when that recession is going to start. Okay, number 3 here, change to the Dow. This was expected, obviously, but Intel is out, Nvidia is in, and this is always hilarious when these members come out of the Dow and they come in. The differential in terms of performance leading up to it is always remarkable, but we've never seen anything as remarkable as this. This is the last 5 years of Nvidia versus Intel. Nvidia is up 2,770% in the last 5 years to become the largest company now in the world with a $3.6 trillion market cap. And Intel, last 5 years, actually down 48%. So Intel, say goodbye to Intel. Nvidia comes in as the semiconductor representative there. And you can see the market cap flip over the last 5 years. Intel was actually bigger than Nvidia 5 years ago. It was 251 billion versus 128 billion for Nvidia. And today, Intel's market cap down to 113 billion, so a huge decline. And Nvidia's market cap at 3.65 billion, largest company in the world. What's fascinating about the Dow is they don't weight the components based on market cap. They weight it on their actual share price, which obviously makes no sense whatsoever. So if you look at Nvidia, even though it's the biggest company in terms of market cap, it's not nearly the biggest company in terms of its weight because it's simply based on its price. And Nvidia is down here at 2% of the Dow index. And Sherwin-Williams, which was added to the Dow, replacing Dow Chemical, is at 5.4%. It's obviously a much smaller company. So just a crazy way that the Dow calculates things. And what's fascinating is the correlation between the Dow and the S&P 500 is actually still very, very high, even though it has this crazy system. So it kind of shows you that over time, the weights of these things hasn't mattered as much as you might think it would, but just really a funny system just using the share price, which really anything would be better than the share price. You could use profits, you could use revenues, you can use any number of things I think would be better than the share price, but that's the way they've always done it. So we'll see. In the past, putting in a new component into the index, you tend to see outperformance heading into the change and then underperformance after. So we'll see. We'll look back in a few months and see if this marked a change for Nvidia. So far, of course, it continues to push higher. Nvidia earnings come out in a few weeks, so they're behind the rest of big tech, and that will be a big one, obviously, to watch. High expectations once again heading into that. So speaking of earnings, we have now 80% of companies reported for the third quarter. S&P 500 earnings up 14% over the past year. Another quarter of positive year-over-year growth. And if we look at trailing 12-month earnings, which is better to look at because it kind of smooths the data here, you can see another record high up around 8% over the past year. If we look at sales, came in above expectations. They've increased 6.6% over the past year. And profit margins, this is an important one, they've been able to maintain their profit margins here at 11.9%. So we had that profit margin dip in 2022 with those higher prices, with inflation. Companies did an incredible job of cutting costs after that, and you can see profitability has bounced back here, still off the record highs we saw from 2021, 13.5%, but pretty good profit margin number around 12% here if we compare to the historical average around 8.9%. If we look at revenue growth among the major companies here in the tech space, got Meta at 19%, AMD 8%, Microsoft 16%, Google 15%, Netflix 15%, Amazon 11%, Tesla 8%, S&P around 7%, and Apple down at 6%. So pretty strong quarter across the board for revenue growth. Nvidia will be the key one to watch in a few weeks. Number 5 here, Buffett seems to be getting more bearish. Berkshire reported their earnings, and what they show with their earnings is what they're doing in terms of cash, what they're doing in terms of stock sales. And their cash pile hit another record high in the third quarter, 325 billion. That's more than double where it was a year ago. So huge spike. You can see this is not just a gradual rise here the past few quarters here, a real big surge higher. And if we look at cash as a percentage of assets, obviously Berkshire much bigger than it was 20 years ago. So you have to kind of adjust for the level of assets. That's moving much higher as well. 28% of assets now. That's the highest since 2004. And it's almost double the historical average, which has been around 14%. So obviously, Berkshire seeing the opportunity set shrink. They're seeing something in terms of continuing to sell their position in Apple. You can see here they sold another quarter of their stake, still their biggest holding, but it's down 67% from the end of the third quarter last year. So huge, huge sales for Apple in terms of Berkshire. And other interesting things that they're doing is they actually did not repurchase their stock. So they were doing buybacks, and they've said historically they're going to do buybacks when they view the company as undervalued. And so likely this is suggesting now they think that Berkshire stock is not undervalued. Obviously had a huge advance along with other financial stocks this year. And they've just been a net seller, and 127 billion year to date in terms of net stock sales. And if you're looking for a reason why are they selling so much Apple, I would point to this chart. It seems to be reasonable. Buffett, known as the greatest value investor of all time. It's a much different picture when they started buying this thing back in 2014. The PE ratio back then was about 10 times. Now it's 37 times. EV to EBITDA at 26 times, and price to sales hovering around 9 times sales. So you could see much different, much higher than the last 10 years in terms of the averages. And so simply they seem to be taking profits and waiting for an opportunity when valuations come down. We know Buffett can be very patient and he could lag for a long period of times. We saw this in the late 1990s. So this doesn't necessarily have to be a signal of anything imminent, but clearly, based on the magnitude of the sales, Buffett seems to be getting bearish. If we look at overall valuation ratios at the US, you can see here the Shiller P or the CAPE ratio rising to 38 this week, highest we've seen since 2021 when the market peaked before the bear market. And before that, you got to go back to 2000. Back in 2000, it was higher, as about 44, I think, at the peak. So could this go higher? Absolutely. But we're in about 98th percentile historically in terms of U.S. equity valuation. So not surprising to see Warren Buffett be a net seller of stocks. Okay, ending here with something positive. Once again, inflation was one of the big issues in the election. The good news is, if we look at gas prices at least, they're coming down, and that will help once again with the next CPI report that we get next week. We're looking at the average, national average price of gasoline in the U.S. moving down to $3.10 this week. So our crude oil sell-off last few days, pretty sizable sell-off, which is nice to see. So good relief here. It's back to its lowest level since January and down on a year-over-year basis. So good news. Would be great to see this go back below $3 a gallon. I think everyone will be happy about that. Okay, with that, Covered a lot of ground this week. Thank you, everyone, for joining me. If you're watching this on YouTube, hit that subscribe button. Have a great weekend, and I'll see you next time on the Week in Charts.